The Eurozone crisis spotlight today focuses on Germany. Two top officials don't mince their words, and Berlin attracts strong demand at a 5-year bond auction. That's despite record low yields. I'm Jamie McGeever, and this is today's Market Pulse. Well, I'm joined now by Richard Maguire, Senior Fixed Income Strategist at Rabobank. Richard, comments from Germany's Economy Minister and Central Bank Chief today left no one in any doubt, if there was any doubt, about Germany's opposition to non-standard measures from the ECB. Of course, the timing is not insignificant.
No, absolutely not. We're one day prior to what is a key ECB meeting. ECB President Draghi has teed up the market. Expectations are very elevated that we will see some form of very concrete policy action tomorrow. We will be looking for some announcement of a plan to intervene in the bond markets of at least Spain, possibly Spain and Italy. But as you say, German officialdom, both the Bundesbank and the government, pouring cold water on such a notion, making it very clear their opposition to this, and noting that easing the pressure on peripheral debt markets sends the wrong signal and reduces the pressure on governments there to instigate reform.
Will Draghi follow through his words with bold action in the face of such opposition from Germany? Well,
bear in mind, Germany's long been opposed to ECB market intervention. The S&P's always been very controversial in German circles, as it were, and that was very clearly evidenced by Stark and Weber, who both reportedly left the ECB specifically because concerns over that particular programme. And what was clear is that even though they are strongly opposed to such a policy channel, they've been unable to block it in the past. It was reactivated in August of last year. So German opposition is not in itself sufficient to prevent the ECB from intervening. The thing is, though, that the ECB themselves have made it clear that they will intervene in a secondary or primary bond market in the periphery, but only as long as a sovereign petitions the EFSF or the ESM for support. And as yet, Spain is still resisting making such a request. So it seems hard how the ECB could do anything apart from announce its willingness to intervene as and when the conditions are right tomorrow, which would, of course, be very disappointing for the market.
OK, well, one day ahead of that, today, of course, these Spanish and Italian bonds are doing pretty well. Stocks are up, these bonds are up. Are you advising your clients to sell into that?
Certainly, I think the risk is slanted towards disappointment at tomorrow's meeting. Expectations have been very elevated as we move into tomorrow's ECB announcement. Today, we are seeing a rally in peripheral debt markets. Some of that may simply be short covering ahead of what is going to be a meeting which is fraught with uncertainty. There's key event risk tomorrow, so investors may be squaring positions ahead of that, which optically at least makes it look like Spain and Italy are having a good day. But I don't think there's anything fundamentally driving that. Against the backdrop of likely disappointment, as I say, we would expect a bare flattening of Spanish and Italian curves as the front end sells off, and most likely a bull flattening of core curves as long ends rally. In fact, we are playing just such an outcome in the form of a 5s, 10s Bund flattener, which we put on 2 weeks ago. We are continuing to run it through tomorrow's meeting on the premise that disappointment is the most likely outcome.
OK, just to finish up, Richard, today's main data was from the UK. The PMI, a big miss on the downside. Sterling's down, but gilts have also fallen against what you might expect.
Yes, well, gilts have pared back the modest losses that we saw this morning in the wake of this weak data point. It seems that gilts are really feeling some of the bearish updraft from Germany, albeit outperforming Germany by some significant margin. Some of that move in Germany is making way for supply this morning in the form of the 5-year auction. Some of it is a retracement of yesterday's marked bull flattening that we saw, which was due to month-end extensions. But as you say, the data is very weak. It is supportive of gilts. Ultimately, it does leave the door open for additional policy action from the Bank of England, but we don't see additional policy action tomorrow. We think November is a more likely juncture for that. After all, the funding for lending programme only officially starts today. The Bank of England would like to see if that has any impact on lending to the real economy. November looks a more likely juncture. We have the inflation report then, where the BOE could hang its hat on any additional policy initiative. OK, Richard, thank you very much. Well, turning to technicals now, our chart of the day shows US yields edging up off the floor ahead of the Fed's policy decision later in the day. But Credit Suisse's David Snedden says that may be more a buying opportunity than a turnaround.
Our view that backups in the US bond market are buying opportunities. Ideally, we'll hold 160 and we'll come back to 140.38 and eventually 113.11. I think even if you get above 160, it probably would just suggest to us a more choppy sideways range rather than a more important reversal. And I think you really just need to start to see yields back above that 173 high to suggest that there's something more significant happened.
That's it for now, but there's plenty more throughout the afternoon, and do follow us on Twitter @Reuters Insider. I'm Jamie McGeever. This is Reuters.